Thank you all very much. Thank you, Jeremy, for the kind introduction. It is a pleasure to be here today. We're going to talk about financial risk for agriculture businesses in a time of uncertainty. And my remarks will touch on three things. Some of the topics just came up in the Q&A. We're going to talk about agricultural price volatility, elevated operational costs, and elevated costs of capital. Those are the three biggest challenges I know that are, for your business right now, the biggest concerns. So let's start with ag commodity price volatility. Last year, the Russian war on Ukraine had a significant impact on all commodity markets, but especially agriculture. Wheat prices spiking to record highs. They've since come back down, but they're still high. Same thing's true. Corn prices spiked really high, near all-time records, still high as well. Soybean prices, a similar story. And then there are real outliers like oat prices that skyrocketed and now are a bit lower. But this isn't just in grains. We've seen this in other areas as well. Cotton prices spiked up and are now at more normal levels. But there are some areas in the agricultural price world, I'm sure many of you see this every day, where it's not true that the prices have come down. One of those key areas, of course, is on the protein side. We see that live cattle prices have continued to rise. I remember having a conversation last year with folks, and they were talking about grain prices early in the year, and I remember warning them that we would see higher meat prices as the year would go on because of that impact of the higher grain price. Obviously, avian flu added more upside to the protein mix of pricing dynamics, and that's what we see for the live cattle. For feeder cattle, those prices are up. They're not nearly as severely up near those record levels that the live cattle are. Part of the reason, though, that we've seen those cattle prices rise is fundamental. It's not just the Russian war on Ukraine. It's not just the avian flu. It's not just the higher cost of grain and the higher cost of everything, which I'll talk about in a minute. But U.S. herd for beef cow replacement is currently at the lowest level since 1962. So this means that for some agricultural prices, even though there's an agreement that's allowed some of those grain prices to come down and some increasing of the exports of some of those grains out of Ukraine, the cattle situation isn't just about that. There's just a lot fewer cattle replacement at these low levels. It's also something that's had an impact in driving up lean hog prices. So across the commodity spectrum for agricultural prices for grains, we might see less volatility than we saw last year. But on the protein side, because it's not just about Ukraine, we could continue to see some elevated pricing and uncertainty. That's just one piece of the mix. I said that we'd talk about three things. Another really important one we're going to talk about is operational costs. So as a backdrop to that volatility, we've also seen increases in potash prices. Not quite at record highs, but moved towards it. Significantly impacted because a plurality of supply comes from Belarus, Russia. Those main sources having an impact. Natural gas prices, another critical element for fertilizer. Last year, those prices spiking up towards $10. Now today, it's closer to $3. Some of that has to do with Europe putting restrictions on import price costs from Russia against a backdrop of tighter supply. I'll talk about all that in just a second. One of the other things, though, that's the shadow side of maybe the upside of the natural gas price piece, is that while last year you might have paid very high prices for natural gas, the U.S. economy benefited from LNG exports. Last year, in the middle of the year, we became the biggest exporter of liquefied natural gas in the world. we became the backstop for European supply of natural gas. The other thing that's happened is there has been an increase in drilling. There has been an increase in inventories. This shaded bar represents the range of inventories over the past 5 years. The blue is the current level. And if we look at the blue, last year, it was at the bottom of this gray shaded range. And now it's at the upper end. So for this time of year, inventories are pretty high, which is a good sign. That's something that could keep those natural gas prices from spiking during the year, as long as those inventories remain solid. One area where inventories have not been a risk in the past year was propane inventories. They've been quite robust. Part of it is, if you drill for natural gas, sometimes you also find that there are other hydrocarbons there, propane, butane, ethane, and as a result of that, propane prices this year in blue, the previous year in orange, and you can see the 22 to 23 prices, that blue much lower than it was in 22 to 23, 21 to 22. The inventory situation, you can see same thing. Shaded bar is the range of the 5 years. You can see that blue line at the upper bound of those inventories, and it has been for a number of months. So if you're concerned about your propane pricing, that situation is much less of a risk, even now, than natural gas. If the situation in Europe becomes more complicated, we could see the natural gas prices go up a lot more, but propane's not likely to face the same dynamics. And then there's diesel. These are the different regional prices. The big story here is that if we look last year, they peak up kind of at June, July of last year, and they've been going down on trend since. I'll talk a little bit more about crude oil prices and fuels prices later. There's more upside from where we are now. And that has a lot to do with the jobs data in the U.S. Probably the most important thing, if you ask me what's going on in the economy that really, really matters, it's jobs. There's a lot of them. Unemployment rates, 3.4%. It's the lowest unemployment rate since May of 1969, so it's been a while. Most recent job numbers, really strong. The unemployment rate on the left, you can see it just going down since the beginning of 2021. We're lower than we were before COVID, where the unemployment rate was 3.5% before COVID. It's 3.4 now. Again, lowest level since May of 1969. Jobs numbers, last month, really big, 517,000 jobs. It's a huge number. The next set of jobs numbers comes out this Friday. It's likely to be a good report too. I know, though, many of you might be saying, but where are the people? Many businesses I talk to, almost every single industry, folks are saying to me, we don't have enough workforce. We're paying more for people than we've ever paid. We're having trouble hiring. If that's not your story, don't tell anyone around you. And you might feel like, gee, there's no people, but there are. The labor force is currently at a record 165.8 million. There are more people in the labor force than at any other time in American history, right this moment. You might say, but what about people collecting unemployment? Most recent data, 190,000 people collecting unemployment, last Thursday's data. The record low was 162,000, which was set back in 1968. The labor force is more than double the size it was in November of 1968. Which means, on a labor force size adjusted basis, fewer people lost their jobs last week than at any time in history. But wait, there's more. Continuing jobless claims showed that 1.655 million people total are currently collecting unemployment. The labor force is 165.8. 1.65 are collecting unemployment. Less than 1% of the entire labor force is collecting unemployment right now. It seems kind of tough to reconcile because I know every day you see these stories, all these layoffs, right? Part of it's relative. This is Facebook, Alphabet, Microsoft, and Apple. And what you see on those four graphics is what their number of workers did between 2018 and the present. So, for example, 2018, there were 36,000 workers at Facebook. In 2022, there were 87,000. And yes, they have laid off 11,000, so now they're at 76. Keep in mind, in 2018, they only had 36. You look at Alphabet, in 2018, there were 99,000 people working there. Last year, it was 187,000. Yes, they have laid off 12,000 people. They're at 175,000. They're up 76,000 workers from 2018. So yes, there have been layoffs, and Microsoft not too different, right? You see these huge run-ups, and then just a small layoff announcement. Now, there will be more layoff announcements. I expect that. But this is not the doom and gloom that you might think the news is sharing with you, right? The headline-grabbing tech layoffs, that's not the big story. The big story is that right now there are 11 million open jobs, right now. Now, that's down from 12 million. But before the financial crisis, you remember like 2006 when everything was just awesome, before the bubble and the everything? There were 4.5 million open jobs then, and it went down to 2. Right now, we're at 11. So you could have all the unemployed crypto bros in the world, and you will have all the unemployed crypto bros in the world, and you still don't have enough truck drivers, HVAC techs, plumbers, nurses, people who can work machinery, forklift operators. So there's the headline grabbing stuff, like all those folks who knew nothing and made fake internet money and bought Lambos, like that's over. But there's still 11 million open jobs right now. And if you look at the numbers, but before COVID, that was 7 to 8 million, which means we're still up 3.5 million, almost 4 million more jobs than before COVID, open, unfilled. Some of this is demographics. 2 pieces. Number 1, in 1 year, 9 months, and 25 days from now, Gen Xers start turning 60. In 2 years, 9 months, and 25 days, baby boomers start turning 80. Millennials will be the entire labor force, or the entire part of prime working age, almost all of it. This is what's going on. Big generational shifts. And as the baby boomer generation, biggest generation in history, leaves the workforce, Gen X is kind of small, they're right behind them. If you looked at labor force participation rates by age cohort, you would see that ages 16 to 19 are the highest they've been in many years. But if you looked at ages 55 and up, they've never recovered. Of course, it is 55 and up. There's no upper bound on how you calculate labor force. It's everyone 16 and up. So this is one way to look at it, just a lot of open jobs. Another way to look at it would be looking at the job postings online. A couple of lines here you see. The red line is the number of people who are employed, and that's on the right axis. The blue line is help wanted online, postings of jobs online. That's on the left axis. You see they moved together for years, but around 2015, 2016, they decouple, and the number of postings online, the blue line, was able to be much lower than the number of people employed. In fact, the number of people employed on this graph, if we did, analyze the lines, we'd see that the employment number could be 8 million higher, was 8 million higher than this index implied. It's the correlation. Well, now you'll notice the red line is not above the blue line. The red line is actually below the blue line. So if you could sustain 8 million more than the blue line, and there's like a 2 million delta, we might currently have a 10 million worker shortfall compared to before COVID. But whether there's 11 million open jobs or 10 million workers fewer, or there's 10 million more open jobs than there were before COVID, it's millions and millions and millions. So for the labor cost side, this is going to continue to probably add pressure. It's one of those areas where inflation, it's kind of tough to get it out of the system. Just 3 years ago, the average hourly wage in the United States was around $28.50 an hour. Today, it's over $4.50 more than that. It's over $33 an hour. I like to think I'm young-ish, but I remember working for less than $4.50 an hour. And that's how much it's gone up in 36 months. So those cost pressures could remain. Another issue that I think could remain and be inflationary and a problem is Cold War II, something we've been talking about for a couple of years, long enough to have it trademarked. It all really starts, on February 4th last year at the Olympics. Most people didn't notice this. It's because there was another party going on, and then there's like this wedding. China and Russia get married. At the Olympics on February 4th, 2022, they issue a joint statement, and they say there is no limit to their cooperation and that they strongly defend the outcomes of the Second World War. It was a while ago. But the implication is clear. This isn't a June wedding this is like a Game of Thrones wedding. Because this is the map at the end of World War II, Russia bigger, China bigger. Russia goes first, takes on Ukraine. The impact is inflation and food and energy disruption globally, and even now the Russian front of Cold War II is pretty much at a standstill. Now, I know most people's attention spans have been run down by Facebook Reels or TikTok videos, which might soon be banned in this country, but wars don't end in 15 seconds. For over a year, I've been writing, and I expect the future of Cold War II is probably Korea. War that's still technically ongoing 73 years later. I know folks thought this would be over fast. It wasn't, in large part because you had Zelensky pushing back. If Afram Ghani had been Zelensky, the outcome in Afghanistan would have been very different. But you have an unstoppable force and an immovable object, and the prospect of this is, at some point, you end up with some kind of demilitarized zone and two sides that are still at war, but they're not going to make peace because for various reasons related to their conflict system, they won't be able to do that. The red is what Russia's annexed, the blue is what the Ukrainians have taken back. But it really is a bit of a standstill at this point. And this all gets back to what was Russia's really big hope, and what were they trying to do even now, dragging it on? And the hope was for Russia that they would be able to use their greatest weapon. And that's the winter. Their greatest weapon they've used, right? They used it against Napoleon effectively, against the Nazis. And they were trying to sow seeds of strife between EU members, pull them apart. In fact, the Russians have always known winter's their greatest weapon, which is why they were more than happy to weaponize it and export it to Western Europe in the form of super cheap natural gas that would make Europe very reliant on them. In fact, Russian natural gas as a dependence, right? Some countries in Europe were over 40% dependent on Russian natural gas. Some of that gas would go all the way from Russia through Europe into the UK. So there's a lot of countries that are feeling the pressure of this. And the question is, you might ask, who knew about this? Did anybody know? And I will tell you, everyone knew. But no one could talk about it. Let me give you an example. 2008, I'm working on a consulting project. It's a Russian-German joint venture. I'm in Europe. My job as a risk specialist, right, coming out of the banking side and the trading side, was to analyze the risk books of this gas joint venture. What that meant is I had to look at the supply and look at the pricing and make sure that they were trading offsets for everything, make sure the risk books were proper, right? If any of you hedge or trade any of the commodities you sell, chances are you have something that looks like this. The catch is the Russian natural gas contracts are up to 30 years long, and they have a very complicated, extremely secret pricing mechanism. Every contract's a little different. It's all super secret stuff. So I'm working on a project. One day, and it's a German project. My first master's is German. Our working language is German. But one day a partner comes to visit, pulls me aside, says to me in English, because he wants to make sure I get it. And he says, Jason, don't ask too many questions. And I said, well, what do you mean? Like, I got to ask questions, I can do the rest. He goes, we don't want to find your body in a dumpster. So, like 2 weeks later, I'm working on a project in Chicago. I actually told that story, and someone in the back said, we got dumpsters in Chicago too. And I said, you ain't found me in one yet. So, but that's a true story. And to give you some idea of how impactful this was and what a risk this was, right? This is all the gas going to Europe. We go back to January 2021, over 450 million cubic meters a day going from Russia into Europe. And today it's closer to 50. This is a huge cutoff of all of those supplies. And as those supplies have gotten cut off, you can see the stack bar chart falling. That's also the black line here falling. The red and the blue are prices, where natural gas in the Netherlands went at one point from $5 up to $100, a 20x increase in their energy cost. That's come back down from that, but still very high. And we are likely to remain the world's largest LNG exporter for some time. So that's one part of the Cold War II piece, right? Russia weaponized winter, and they've really tried to choke Europe with it. And of course, Europe trying to go full sustainability, climate change, right? Go as green with their energy as possible, shut down coal plants. Germany has some of the biggest coal deposits in the world. Right? Coal and steel, that's how Germany became a country. They also had nuclear power plants that they mothballed and decommissioned ahead of schedule because of the push to have greener energy. Now, the push to green energy, there are many different reasons why this makes sense, but now we see there's something called the energy trilemma. You don't just want energy clean, you don't just want it cheap, you also need to know it's actually going to be there. And this is the problem with the Russian natural gas. That's one front. The Chinese front is perhaps even more nefarious. This is a graph showing emerging market debt. And if you look, what's happened here, You'll see a dark shaded blue section that goes from very small on the left, which is in the mid-2000s, up to a big chunk on the right. That's emerging market debt held by China. China is currently the bank for 70% of emerging market debt. Last year, money fled emerging markets on the left, but it fled even more from China. The reason is big investors are very concerned that what happened in Russia could happen in China. Let me explain. If last January or even February you owned Russian iShares, you owned like an ETF of stocks of companies in Russia, it was worth something. And a couple months later, it was worth nothing. Russia's economy is not very big in GDP terms. It's roughly the size of Italy. It's not that big. China's very big. What happens if all the stuff in China is suddenly worthless? What happens if what happened in Russia, where you had companies that manufacture goods, assets, all kinds of things? What happens if all those things in China become distressed assets and go to zero? What happens if the supply chain you might rely on for equipment or parts or whatever, what happens if that stops? And y'all know what the Business Roundtable is? At the federal level, 100 CEOs who advise elected leaders about policy and stuff related to business. Well, there are about 28 states that have a roundtable like this. In Texas, it's the Business Leadership Council. I'm one of those 100 CEOs. It was actually founded by George W. Bush as the Governor's Council, part of his transition team in 1994. And on our recent trip to DC, where we're a nonpartisan organization, we meet with representatives, both parties, usually one or two of our senators in the administration, whichever party happens to be. But in one of those meetings, we met with the Business Roundtable, so not quite the parent organization, but an affiliated larger entity at the federal level. Here we are, a group of Texas CEOs sitting down. One of the folks is in manufacturing. Asks their trade expert, I have a part, it's made in China. What should I do? And the trade expert looks at the CEO and says, can you get it somewhere else? And the CEO says, no, you can only get it from China. The trade expert looks at the CEO and says, you need to get it somewhere else. The trade tensions between the US and China are going up. The military tensions between the US and China are going up. Just this week, China increased its budget 7.2% more of its annual budget towards defense, explicitly calling out the US. And while we might be divided as a country on many different political issues, surprisingly, there's one the American public agrees on, and it's China. 82% of Americans view China negatively right now. Only 16% view China positively. In a recent survey from the Atlantic Council, around 70% of experts in national security and forecasting and these sorts of things expect China will take Taiwan by force in the next 10 years. Now, Russia doesn't care if Ukraine is a mountain of rubble. Let me make that clear. They did it in Aleppo, they did it in Grozny. They do not care. They want the land. They don't care what's there. But 90% of the highest-end semiconductors are made in Taiwan. China wants that golden goose without killing it. That means something like an amphibious landing across a strait that's 4 times the distance of Dover to Calais, which will be extremely difficult, and which the Taiwanese are very willing to resist, and for which Ukraine is a roadmap of resistance. Right, like a rocket launcher on every shoulder works. The Chinese don't want that because they want the semiconductor industry. So if I was a smart guy advising a bad guy and looking back at Cold War I, I would expect at some point China does a naval embargo, some kind of blockade around Taiwan. The U.S. naval ships won't be deterred, U.S. shipping probably won't be deterred, but many other countries might be. And it's a lot bigger place than Berlin to do an airlift to. China's key strategy with us has been to move so slow that a significant response would seem irrational. They took a bunch of uninhabited atolls in the South China Sea and gradually turned them into islands and then landing strips and then full-fledged military bases. But they did it so slowly that if we pushed back really hard, it would have seemed crazy. So I suspect whatever they're going to do, they're on a much longer timeline than we might expect. Their goal isn't going to change. Now, you heard earlier China's population's declining. That's true. Black line is births. Yellow line is deaths. Last year, deaths exceeded births for the first time in China. China's population probably peaked in 2022. Based on some of the data from the UN, and this data pulled together by Charter, 2023, this year, India's population is likely to overtake China. By the end of the century, India is likely to have 1.53 billion people. China's projected to have 770 million. Still a lot of people, but a lot fewer than there are today. By the way, in 2050, Nigeria's population is poised to overtake the US population, which is still rising, but at a very slow pace. To give you a couple other ideas of how this might play out, there's not just one forecast, there's actually four different scenarios or three different scenarios for how this could play out for China. Right? There's the 770-ish million potential. There's also a potential that maybe at the end of the century it's closer to 1.15 billion, but there's also a case in which it's below 500 million at the end of the century. The one China policy is coming home to roost. Population's going down. That's going to make Cold War tensions, that's not going to make them go away. And you might be thinking, well, like what will happen with manufacturing? I would encourage you to consider that the country with more robots than any country in the world right now is China. And I know in the US, we're worried about automation, we're about AI, we're worried about robots. For us, they're a concern. In China, they're a reality. So now that we've talked about those kinds of operational risks and costs, I want to talk about the cost of money. Two-year Treasury right now sitting just below 5%, 4.89. Last year it was 1.5. 10-year Treasury last year below 2%. It's now over 4% for 10 years. Now, the other thing is it's a little bit lower than it was in November. Right? November, it was a lot higher. Part of the reason is there is conviction and belief that the Fed will kill inflation. But inflation's high, right? The blue line here is total inflation. You can see it peak up in June at 9.1%. Now it's at 6.4%. That's a good drop, right? That is a good drop. But the Fed's target doesn't fit on the graph. It's 2% down here. But we're moving in the right direction. Part of the reason this is so important is because if those 10-year Treasury rates remain above 4%, we have a lot of government debt, right? That $31 to $32 trillion, refinancing that at 2% or 3% is a lot better than refinancing that at 4% plus. One thing that makes me optimistic, though, about the inflation it's going to keep falling is producer inflation. This is wholesale inflation. Manufactured goods of all kinds. That inflation's 7.5. Now, 7.5 is higher than the 6.4. But in June, it was 17.9. So the year-on-year inflation rates are coming down. But while the year-on-year rates are coming down, they're still positive numbers. So let me just clarify on this. Even though the percent number is going down, right, this is a second derivative issue, the price is still going up. Same thing with wages. We're never going back down to $28.50 an hour. Even in the Great Recession, hourly wages went higher. Even after the housing crisis and the financial crisis, the whole thing, wages still went up every year. We're not going back down. And of course, if you're looking at riskier credit, the price is even higher. You look at junk bonds last year, about 5.5%. Now they're 8.6%. That's also lower than it was in November when it was closer to 9%. Triple C and lower, extremely distressed junk bonds. This was almost 17% back in November. It's now about 14.5%. Last year it was 9.4%. All kinds of credit are a lot more expensive than a year ago, but they may have peaked because of that longer-term conviction that the Fed will kill inflation. Still, with persistent high inflation and central banks still raising rates, financial markets are under pressure, and the impact is rapidly slowing global growth. This isn't just going on in the US. And by the way, I mentioned the debt thing with China earlier. Emerging market debt rates are up a lot. For emerging markets, the cost of agriculture and food is a bigger part of their GDP, and those prices are still elevated. By the way, those prices are also dollar denominated, and the dollar's really strong. This is debt trap diplomacy. Basically, China is the emerging market payday lender, and emerging markets are in a bad way right now. This is what's triggered that everything sell-off, right? Borrowing money's expensive, which weighs on profits. We're likely to see that in the next couple of quarters where corporate profits come under pressure. Yes, revenues are going to be very high, but the labor cost piece is a tough one, especially in the service sector. Those rates are just really going to eat profits. High interest rates also, like by math, make valuations fall. So if you're looking to sell a business, you don't want to do that when interest rates are high. But if you're shopping for one, you want to be buying now because that higher interest rate depresses current values. This also means less risky investments are more attractive. The impact and the implications are you should be strategically focused on cash flow, and we would expect more emerging tech consolidation and failures. Seen some of the layoffs, you see what's happened with companies like Carvana, you're going to see more of these things. Seeing what's happened with Zoom, you're going to see some of these things. But the everything sell-off, even that, there are downside risks in the next couple of quarters. But this is the Dow. It's down a little from the top, but it's not in a catastrophic spot. And of course, the NASDAQ's in a worse position. But that's because you've got some of the emerging tech companies that don't run a business the way you run a business. I suspect, tell me if I'm wrong, that y'all run a business where buy low, sell high, make money. Like, I think that's right. But tech companies have a thing where the more you lose, the more you're worth. It's not really business. Doesn't make a lot of sense at 0% interest rates. Makes a lot less sense with the Fed knocking on 5% rates, right? That's why the NASDAQ's under pressure. But there are other areas where some of the downward pressure is maybe more beneficial to the economy. Baltic Dry Index is down. So if you're shipping bulk grains, anything like that, your freight costs waterborne, a lot less than it was a year ago. Lumber prices also down quite a lot. Like many other commodities. Big spikes. Now down, but they're still elevated. And they've actually gone up in the last couple of months. The dollar, though, has been one big exception. Even though it's come back down, the dollar is really, really strong. And the Fed is still raising rates. And Europe is still facing an energy crisis. So if you ask me what will make the dollar really just collapse here, it's tough. Europe's in a worse spot than we are. We're in a better spot, and we have 11 million open jobs. You know, the Fed has two mandates. The Fed's mandates are low inflation, low stable prices, and full employment. We clearly have well beyond full employment, and we most certainly do not have low stable prices. But with 11 million open jobs, they've got a green light to go further. The other area I would caution is oil prices. They're down a lot since the middle of last year. Again, that was a lot tied to Russian war on Ukraine, dislocations in global crude oil markets. But with the lowest unemployment rate since 1969, lots of people have jobs. You know what they do in the summer? They travel. If you haven't booked your summer travel, I have very bad news for you. It's going to be the most expensive flights you ever book. I've seen domestic business class flights that look like flights to Europe. Business class to Europe. The pricing's crazy. In January, my wife and I were looking at going to Vegas around Memorial Day weekend. Southwest flights, $700, $800 each, 4 months in advance from Austin. Business class flights, close to $2,000, 4 months in advance. So it's going to be a big driving season, a big flying season, travel everywhere, everybody all at once. That's going to push oil prices higher this summer. Even if global growth slows. Because here's the secret. We are the biggest consumer of crude oil in the world, and the biggest source of seasonal crude oil demand in the world is the U.S. summer driving season. Now, there's one other market I probably should talk about, right? You know, the magic internet money, crypto. Like, if you don't know what crypto is, I will give you the one big takeaway that you must know. You cannot spell crypto without cry. So now I want to turn, though, to something that's a bit more optimistic, and that's the real estate lessons we learned. Currently, owner-occupied real estate in the U.S. is worth about $42 trillion. 3 years ago, it was worth $30 trillion, a little under 30. It's gone up over 40% nationally in 3 years. By the way, owner-occupied real estate isn't just houses, townhouses, condos, it's also ranches or farms, anywhere where the owner lives. So there's been a huge increase in real estate values. And you'll notice it's kind of still stuck up there. This is quarterly data. We have the most recent quarters. Even though mortgage rates have gone up a lot, right? 30-year fixed, most recent data, average 6.5%. It's a little bit down off the peak, but it's a lot higher than it was a year or two ago. Prices are kind of sticky. Why is that? Let's talk about it. First up, I know there's a lot of talk about U.S. government debt. We also have a record level of consumer debt. This is the stacked bars. I'll talk about those in a second. Orange is mortgage, then it's HELOCs, auto loans, credit cards, student loans, and other debt. Right now it's about $16.9 trillion. More debt than we've ever had. But mortgage credit qualities never looked so good. These stacked bars represent the billions of dollars issued every quarter in mortgages. The important part is the color scheme. You see on the left, there's like 4 different colors, but on the right, it's mostly that light blue. For the last 3 years, that light blue, that's been 2/3 to 3/4 of mortgages. It represents credit scores 760 and up. To reiterate, 2/3 to 3/4 of all the mortgages issued in the last 3 years at record low interest rates went to people with 760 plus credit scores. Those credit scores do not fall out of the sky. So, what does our debt delinquency numbers look like? I have good news. Right this moment, as we sit here, just published, U.S. debt delinquency is the lowest in history. 2.5% of all consumer debt is delinquent in any way, shape, or form. We go back over time, the green is like 30 days delinquent, the red is severely derogatory, and there's different levels of dates in between. But what you'll notice is the furthest bar on the right is the all-time record low. And the 6+ quarters to the left of that were previous near or at record lows. Consumer credit in the US has never looked this good. No surprise, there's less than 1% of the labor force is collecting unemployment. Everyone has a job, making $33 an hour on average. People have jobs, people have money, people refied at super low interest rates with really high credit, and they are not delinquent on their debt. That is the very good news. And if you ask me about the US economy, I would tell you that's what makes me really optimistic. Moreover, again, you might be worried about land prices and housing prices. Allow me to share a couple statistics. Rental vacancies were at 5.8% in Q4 of last year. This is the lowest level since 1984. So there's nothing to rent, and everyone has a job, which is why rent is up 8.6%, the most since late 1981. I'm not worried about the housing crisis. We learned that lesson. We completely forgot the tech bust lessons, but we definitely learned the housing one for this cycle. So let me share some key expectations, some operational takeaways. First up, we do expect some operational costs to ease, the year-on-year rates to go down. If you're waiting on equipment and you've been quoted in weeks like 50 weeks or 60 weeks, right? You're going to be quoted in fewer weeks going forward. Supply chains are easing up. Some operational costs will ease. That's why producer inflation is up 7.5 for goods and not up 17.9. Some of the pressure's coming off. Agricultural price volatility, especially I would suspect on the grain side, is likely to ease, but it's still uncertain. Cost of capital, I expect end of this year, next year, we'd see lower costs of capital as the conviction that the Fed kills inflation goes up, right? Short-term rates might remain elevated, but those longer-term rates under pressure. But be prepared for them to remain elevated. Now, there are a couple winning strategies for uncertainty. Y'all know I'm an economist. You know, most economists, they talk about two things, right? Like what drives markets? Y'all are in markets. What are the two things that drive markets? Supply and demand. I thought y'all knew what was up. It's fear and greed. Will always be true. And as you're worried about agricultural market volatility, maybe you have this exposure to these near record high beef prices, or maybe you're wondering what's going to happen next with grain prices after having such a big fall off from such a big spike. I would share with you that what most companies do as best practices for hedging strategies is that they have a consistent plan and they tend to hedge more in the present and smaller amounts further out. So this quarter ahead, you might hedge 50%, but 2 years from now or next year, you might hedge 5%. And you have a rolling hedge that goes forward. And as time becomes closer, you increase your percent hedged to lock in your profits and protect yourself from downside. That's the best practices across most commodity businesses. And then the final thoughts, as you face these challenges, which there are many I have talked about, I would still strongly encourage you to focus on ROI and minimizing costs where you can. Account for sticky inflation. If you have contracts, making sure that you account for that using objective measures. Really important. Be cautious with speculative investments. Right? This isn't the time to go wild, not with these interest rates where they are. Prepare for a protracted Cold War II. Don't think that's going to end anytime soon. Focus on operational resilience and cash flow, and then assess options to reduce or offset your risks. The last thing I'll share is, and I know folks are really concerned about the decline of birth rates in China, population is still rising. By 2050, the global population is expected to be around 9.7 billion. So between 2020 and 2050, there's going to be like almost 2 billion more people on the planet, even though birth rates are going down. By the way, birth rates have been going down everywhere for a while. There's a book about this, came out about a decade ago, and it's called What to Expect When No One's Expecting. Every country is seeing birth rates go down, but some of them are going from really high levels. And the area where the population growth is increasing, it's in some of the least developed countries. We're talking emerging Asia, emerging Africa, emerging LATAM. A disclaimer, everything could be wrong. Or for the conversation about the Cowboys earlier, past performance is not indicative of future returns. And that's my contact info. I know we have time for just a couple of questions. I thank you very much. Please, you have a question in the back.
You've written extensively on robotics and automation. How do you see that impacting agriculture in the future?
Thank you very much. I appreciate the question. Yeah, robotics is going to be used. I know every time there's been a step change in technology, it comes to agriculture, right? In the mid-1800s, 2/3 of the population worked in agriculture, right? And today it's a couple percent. We're going to see increased use of robotics and automation in all sectors. I suspect you'll see it a lot more in the agricultural space in many different ways, right? On the ground, in the air, in the water, everything. I just think, especially with the labor constraints, right? There's 3 ways you get economic growth: capital, labor, technology. And the technology piece is going to be really important, especially for maximizing the utilization of the arable acreage that we have on planet Earth. If we add 1.9 billion people, and by the way, their real per capita GDP everywhere on Earth is going up, that's going to really drive up demand. That's going to really put pressure to increase productivity. I think that's where robots and automation are going to be really, really important. On the software side, you're going to see that accelerate as well in all industries, including ag. You got another question?
Yes, the government is really pushing for electric vehicle use over the next few years, and car makers are building a lot more electric vehicles. What's going to be the future of the gas and diesel industry, and specifically also the price difference between gas and diesel? As farmers, we use a lot of diesel fuel, and the price has gone from being cheaper than gas to more expensive than gas. I was wondering about the difference between it.
Sure. Thank you for the question. So it's a few pieces. One, electric vehicles is probably not the entire solution to having greener energy, electrification and the whole thing. Part of that is we're not mining enough of the materials. So if we wanted to actually have a lot more electric vehicles, we need to be mining a lot more. IMF data shows we're only mining 100% of the lead we need to get to net zero by 2050. But we're currently mining only 60% of the annual copper we need through 2050. We're currently mining, I think, around 30 or 35% of the nickel, right? And there's other metals. We have a massive shortfall of what we would need to have a lot more battery-powered vehicles. I suspect that most personal vehicles, like my car sits in a driveway 95% of the time, it's going to be gasoline. Why? Because the battery materials are extremely rare and expensive, and I don't use my car much, right? Vans going around or other commercial vehicles, those will be used more. But personal vehicles, I think you're still going to see a lot of gasoline-powered personal vehicles. Long-haul trucking, I think the hope for that's hydrogen. Batteries don't really work well with that. But for now, diesel's probably going to still be really, really important. And of course, global shipping and transport, diesel's really important there. More people on the planet doing more trade with more economic growth, it's going to require some diesel. So I think there's going to be a lot of different attempts to drive different energy solutions, but it's a really big mix. And the demise of oil, though, is great. The death of oil is perhaps greatly exaggerated. So with that, I know I've got to go, but thank you very much. You're going to love hearing from President Bush. Y'all have a good one.